On January 11th, 2026, a valuation metric that Warren Buffett once called probably the best single measure of where valuations stand at any given moment just crossed a threshold that has preceded every major stock market crash in the modern era. The Buffett Indicator, which measures the total value of all US publicly traded stocks divided by GDP, hit 223 to 224%. This isn't a minor milestone. This is a signal that has shown up at the exact moment of maximum danger 3 times in the last century, in 1929, in 2000, and in 2007. Every single time it reached these levels, within 18 months, the stock market experienced catastrophic declines of 40 to 70%. We're now watching that same indicator trigger, and most investors don't even know it exists. See that?
The fundamental logic behind the Buffett indicator is deceptively simple but profoundly important. GDP represents the total value of everything the economy produces in a year. It's real goods, real services, real economic output. The stock market's total value represents what investors believe all those companies are worth in present value terms. In a healthy economy, these two numbers should bear a reasonable relationship to each other. If the economy produces $31 trillion in goods and services, the stock market value should be somewhere in the range of $50 to $65 trillion, roughly 1.5 to 2 times GDP. When the stock market value grows far faster than GDP, it means investors are paying increasingly high prices for the same amount of economic output. It means valuations have detached from economic reality. Here's the current data that most people haven't confronted. As of January 11th, 2026, the total U.S. stock market value sits at approximately $70.7 trillion. U.S. GDP is approximately $31.8 trillion. That puts the ratio at 223 to 224%. To put that in historical context, let's examine what happened the last 3 times this indicator reached extreme levels. In 1929, just before the Great Depression crash, the Buffett indicator stood at approximately 189%. Investors thought they were in a new permanent plateau of prosperity. Economist Irving Fisher proclaimed that stocks had reached what looks like a permanently high plateau. 6 months later, the stock market fell 89% and the economy contracted 30%. It took 25 years for stocks to recover to pre-crash levels. In 1999, as the dot-com bubble reached its absolute peak, the Buffett indicator climbed to approximately 150%. Not quite as high as today, but extreme by any historical standard. Investors were intoxicated with the idea that technology and the internet had fundamentally changed capitalism, and that traditional valuation rules no longer applied. The Nasdaq was trading at 200 times earnings. Companies with no profits and no business model were commanding multi-billion-dollar valuations. And the Buffett indicator stood at 150%, signaling danger. What happened next? The Nasdaq fell 76% over the next 30 months. The S&P 500 fell 49%. It took until 2007 for the market to recover to pre-crash levels. Investors who bought at the peak in 1999 didn't break even for 8 years. In 2007, just before the financial crisis, the Buffett indicator stood at approximately 110%. That seems lower than 1929 or 1999, but it's important to understand why. The stock market had already experienced a significant decline from the 2000 peak. The indicator had come down from the 150% extreme. But 110% is still far above historical averages and still in the danger zone. The financial system looked strong in 2007. Banks were profitable, the real estate market was booming, unemployment was low, policymakers couldn't see the crisis coming, yet the Buffett indicator was screaming danger. What happened next? The S&P 500 fell 57% from its October 2007 peak to its March 2009 bottom. It took 5 years for the market to recover to pre-crisis levels. Now, let's look at what separates these extreme readings from normal market conditions. The historical average for the Buffett indicator is approximately 80 to 100%. When the ratio is in that range, valuations are reasonable. When it climbs to 110 to 150%, valuations are stretched and investors should become cautious. When it exceeds 200%, as it has today at 223%, valuations are in the danger zone that historically precedes major crashes. The current level is higher than 1999, 150%, higher than 2007, 110%, and approaching 1929, 189%. We're in uncharted territory at the most extreme valuation level in American market history. But here's the critical detail that makes this moment so significant. The Buffett indicator isn't the only valuation metric at extreme levels. The Shiller cyclically adjusted price-to-earnings ratio, also known as the CAPE ratio, stands at 40.58 as of January 2026. The historical average for CAPE is 17.3. The current reading is 135% above average. Investors are paying $40.58 for every dollar of average earnings over the past 10 years. The only other time CAPE reached 40 was in 2000, just before the dot-com crash. The second highest reading was 32.7 in 1929. So CAPE is telling the same story as the Buffett Indicator. Valuations are at historic extremes comparable to the peaks of 1929 and 2000. The forward price-to-earnings ratio, what investors are willing to pay for next year's projected earnings, stands at 23. The historical average is 14 to 16. Investors are paying 45% more than historical norms for projected earnings, and those projected earnings are themselves optimistic, assuming that corporate profits will grow even as the Federal Reserve is cutting rates and recession signals are flashing. If profit growth disappoints, which it typically does when the Buffett Indicator is this high, then the forward PE will reprice lower, taking stock prices with it. Now let's examine the mechanics of how the crash happens when the Buffett Indicator is this elevated. The process typically unfolds in stages. First, some event occurs that causes investors to question whether the optimistic earnings projections will actually materialize. In 1929, it was the recognition that stocks had become completely detached from underlying economic value. In 1999-2000, it was the realization that internet companies would never actually become profitable. In 2007-2008, it was the discovery that the mortgage market was imploding. In 2026, the event is likely to be Q1 2026 earnings disappointment when companies report profit margins compressed by capex spending and tariff headwinds. Once that questioning begins, investors who have been buying in anticipation of continued price appreciation start taking profits. They don't all sell at once, but the selling pressure accumulates. Volume increases, bid-ask spreads widen, liquidity gets thin. The market transitions from orderly decline to accelerating selling. This is stage 2. Institutional investors who have been holding for long-term appreciation start facing questions from board members and limited partners. Why are we holding this? Pension funds that have been fully invested in equities start asking whether they should reduce exposure. Hedge funds that have profited from the bull market start asking whether the risk-reward has shifted. Once institutional selling begins, stage 3 emerges, the cascade. Passive index funds that own stocks in market cap weighting must rebalance as prices decline. When the largest stocks decline in price, they become underweight in the index. To maintain index weightings, index funds must sell other stocks and buy more of the declining mega-cap stocks. But that buying doesn't support prices. Momentum is gone. So while index funds are mechanically forced to buy declining stocks, the overall market is selling. This creates a collision between forced buying and voluntary selling always wins. Prices continue to decline. Margin calls emerge in stage 4. Investors who bought stocks with borrowed money face maintenance margin requirements from their brokers. As stock prices decline, the equity and margin accounts falls. Once equity drops below the required level, brokers issue margin calls. Investors must either deposit more cash or sell positions. In a declining market, most investors can't deposit more cash, so they're forced to sell. The problem is that forced sellers don't choose what to sell based on fundamental value. They sell whatever is most liquid. They sell the largest stocks, the most heavily held stocks, the ones that appear in index funds. This creates additional selling pressure on precisely the stocks that the index funds are trying to support. The cascade accelerates. The data on margin debt makes this particularly relevant now. Margin debt as of late 2025 exceeded $950 billion to $1 trillion. That's growing at more than twice the rate of the S&P 500's price appreciation. The ratio of margin debt to stock market gains is at levels not seen since 1929, 2000, and 2008. In other words, the financial leverage in the system is at the highest levels in a century, precisely at the moment when valuations are at the highest levels in a century. This is the most dangerous combination possible. When highly leveraged investors face forced margin calls in a declining market, the selling becomes mechanical and unstoppable. Stage 5 is the complete repricing. At this point, investors have abandoned any pretense of valuing stocks based on fundamentals. They're selling because they expect further declines. They're selling because they see others selling. They're selling because they're terrified. The Shiller CAPE ratio, which is 40.58 now, reprices down to 20 to 25 as the market falls. A 40% decline from today's levels would bring CAPE down to 24, which is still above historical average but within the range of fairly valued rather than extremely overvalued. But that 40% decline takes the S&P 500 from 6,900 to 4,100. Retirement accounts that have grown for 15 years see 40% of their value evaporate. Here's the critical part that most people miss. The crash doesn't happen all at once. It unfolds over 18 to 24 months. There are relief rallies along the way. There are statements from Federal Reserve officials promising support. There are earnings reports that beat expectations. But the overall trend is down because fundamentals have shifted and valuations have to reprice. The typical pattern looks like this. Initial 15-20% decline as investors recognize earnings disappointment. That seems like a buying opportunity, so money flows in briefly. Market rallies 5-10%, but the rally fails as more data confirms that the earnings disappointment is structural, not temporary. The decline resumes, accelerating to 30-40% as margin calls trigger and forced selling accelerates. Panic selling in the final stages drives the decline to 40-70% as investors capitulate. The timeline is crucial. We're currently at the Buffett Indicator trigger point, 223% on January 11, 2026. Q1 earnings season begins in late April 2026 with early reporters. The full avalanche of earnings typically hits in May 2026. That's 4.5 months away. If the earnings disappoint and the cascade begins, we'd expect significant decline by summer 2026. If the Fed panics and cuts rates aggressively, that might extend the timeline through late 2026. But by early 2027, if historical patterns hold, the market should be significantly lower than today. Now let's talk about what this means for different investor profiles. For someone in early retirement drawing 4% from their portfolio, a 40 to 50% market decline over 18 to 24 months creates a sequence of returns risk that's nearly impossible to recover from. If your portfolio declines 40% in year one and you're withdrawing 4%, you're actually withdrawing 6.7% of your remaining capital because the denominator has shrunk. If the market stays down for 2 or 3 years, you've depleted capital through a combination of forced selling and unsustainable withdrawal rates. This is the nightmare scenario for retirement planning. For someone 5 years from retirement, a 40 to 50% decline in the next 18 months is actually an opportunity. Valuations will be reasonable after the crash. They can buy stocks that were priced at 40 times earnings for 20 times earnings. If they redirect the next 5 years of retirement contributions toward stock purchases at reasonable valuations, they might actually end up better off than if the market had continued climbing at high valuations. For someone in accumulation phase with 20 plus years to retirement, the crash is merely an uncomfortable interruption. The historical data shows that buying stocks at depressed valuations after a crash produces superior long-term returns. The people who bought in 1932 during the Great Depression ended up with exceptional returns over the next 20 years. The people who bought in 2009 during the financial crisis ended up with exceptional returns over the next 10 years. The challenge isn't long-term returns. The challenge is having the stomach to buy when the market is crashing and everyone else is panicking. The Buffett Indicator doesn't predict the exact timing of the crash. It predicts the vulnerability. At 223%, the market is vulnerable to a 40-70% decline. The trigger will be some event that causes earnings disappointment. The cascade will unfold over months or quarters, but the endpoint is mathematical. Valuations this extreme don't persist. They either compress through price declines or they compress through earnings growth that makes the prices reasonable in retrospect. Given the structural headwinds facing the economy in early 2026, tariffs, capex spending burden, margin compression, margin debt, recession signals, the earnings growth path seems unlikely. The price decline path seems probable. The historical precedent is clear. When the Buffett Indicator reaches 200% plus, something breaks. It broke in 1929, leading to an 89% decline. It broke in 2000, leading to a 76% decline in the Nasdaq and 49% in the S&P 500. The market is now sitting at the trigger point. The valuation metrics are screaming danger. The leverage in the system is at historic extremes. The Buffett Indicator has signaled danger just as it did before every major crash in modern history. And most investors have no idea that this metric even exists, much less that it's at the most extreme level ever recorded. This isn't prediction. This is description of the current state of valuations and the mechanical processes that historically unfold when valuations reach these levels. Whether the crash happens in 2026 or is delayed into 2027 is uncertain. Whether it's 40%, 50%, or 70% is uncertain. But that the Buffett Indicator at 223% is a warning signal of severe danger ahead is not uncertain. The data is clear, the history is clear, and the next 18 months will tell us whether that warning signal was accurate.